Good morning, good evening, good afternoon, or good night depending on when you're watching this video. Welcome back to Optimal Productions. Today we'll be talking about a topic that actually influences the stock market as well as the whole macro economy in general. So we're going to, today's video is more about investing in stocks, bonds, mutual fund, index funds, blue chip stocks. So about investing in general. Oh, as well as real estate. This topic of investing cycles and the boom bust cycle actually could be proclaimed to a lot of investments, whether it is real estate, stocks, bonds, mutual funds, and just basically any type of investment. Okay. So what we'll be covering in today's video is a few main things. The first thing is we'll be talking about the boom bust cycle or the investment cycle. That's one of the biggest things we'll be talking about. And the second thing is how the Federal Reserve's interest rates, the interest rates that the Federal Reserve has for different banks, affects the whole economy as a whole. Okay. So when we look at the boom-bust cycle, we must think of four main things, right? So in every economy, there's always these cycles. It's kind of like the seasons of the year, right? There's the spring, there's the summer, there's the fall, and there's the winter. Now, similarly, we could also assign four main categories of the boom-bust cycle and to a particular period of time, right? So in the boom-bust cycle, which is universally spanned across basically every economy, there's these four main stages or seasons that you could see. Four main seasons of position within the boom bust cycles. The first one is the peak, is when the economy generates growth and the stock prices are generally really high, and spenders and consumers have a lot of confidence in the economy, so they spend a lot of money. Businesses get a lot of money in return, so basically the economy is all happy and gay. And the second one is the recession. So after the peak, there is usually a catalyst. A catalyst could be anything as a housing bubble, could be the dot-com bubble, could be anything from a 9/11 terrorist attack. These are all catalysts that cause a recession. So if we look back at the 2008 housing crisis, or the dot-com bubble in the 90s, these are all catalysts that cause a recession to follow. A catalyst could be anything from a housing bubble, a government change in law, or even something as simple but profound as a terrorist attack on 9/11 of September 1st. So these are catalysts. So usually there will be a peak when everybody is generally happy with the economy is booming, and then a catalyst happen, which is shortly followed by a recession. This is when stock prices generally fall, consumers and businesses start spending less money, so the economy confidence starts to fall. People spend less money, businesses make less money, so that's why the stock prices fall. So when you look at the economy, you really have to see the different chains of events that lead to the next event. So events don't just happen on their own. They must be a cause and effect, right? So on a catalyst, maybe a cause is the 9/11 terrorist attack. Now the effect of that is people lose confidence in the government, people lose confidence in the security, people lose confidence in the economy, right? That causes a recession. Even if it's a small recession and still a recession, and stock prices might likely go down and fall. Generally, in most cases leading up to 2018 and 19, a recession is soon followed by your recovery, or people started to gain confidence, to regain confidence in the economy. People started to regain their belief that the economy is after all a sustainable method for their transactions, and they started to gain confidence. They started to believe and started to spend more money in the economy. That's when the recovery starts to happen. More cash flow is happening within the society. So that causes a recovery, where customer confidence within the economy starts rising, which causes a stocks gain momentum. After that, it's the expansion, right? after economy recovers from a recession, economic growth started to happen, and expectations for the economy started to rise, right? And after that, you reach the peak and a catalyst in a recession. So this cycle could be seen repeated numerous times, from the dot-com bubble of the 80s and 90s, which is the peak. The catalyst would be the 9/11 attacks, which causes a minor recession. The government lowers interest rates, causes recovery, and businesses and people's general confidence in the economy started to grow and recover, and expansion happens all the way to 2008, when it reaches the peak again with the housing bubble. People lend a lot of money, and government changes some of the rules and regulations, and a catalyst happened. A lot of people went homeless, a lot of people went bankrupt. The economy was generally in a really bad and depressing state. That's the recession. And there's a recovery, and generally at 2012 to 13, it recovered from the 2008 crash. And after that, expansion, and people now are quite confident in the economy, with the S&P 500 reaching all-time highs now with Trump in office. But what we're trying to say is, in the economy, there's always these cycles. These cycles are, you can't predict the precise timing, but you know they're coming. So right now in 2018 and 19, we can see that our economy is in some ways in the peak. People are having a lot of confidence in the economy. Not a lot of major blows or catastrophic events or rules and regulations are in place to cause a recession. Now, and then that's the first part of this video. I have talked about and basically taught you guys about what the boom-bust cycle is in a nutshell, right? So your economy goes to a peak, right? It reaches a catalyst, it falls down, it goes to recession, it slowly recovers, and it expands, and it reaches a peak. Right? So this is generally what it looks like. So your economy goes through a peak. Everybody is really happy. A catalyst happened here. Maybe it's the 9/11 attacks. A catalyst happened. A recession, where everybody is just sad. It could be seen as the Great Depression during the 1920s. That's also one of the worst examples and one of the most prominent examples of a recession. And the recovery for that is, of course, World War II. A lot of manufacturing is needed, and then the expansion, and then now with America as one of the superpowers. Now, one of the main methods the Federal Reserve helps the economy to get out of a recession is to lower interest rates. Now, the cost of capital set by the Federal Reserve, so that banks could take the capital and deploy it into the economy for businesses to grow. Now, let me repeat that again. The cost of capital set by the Federal Reserve, so the banks could take the capital and deploy it into the economy for businesses to grow. Now, what is this talking about here? It is talking about during the recession, where people, businesses and consumers have really little faith and hope in the economy. The Federal Reserve would often, as you can see in the 2008 crash, lower interest rates so that businesses and consumers could actually spend more money on the economy, which boosts the cash flow, causing the recovery and the further expansion. Now, here's a neat little diagram showing how interest rates could actually affect economy as a whole, right? So as you can see, these are the interest rates. If the Federal Reserve rises the interest rates, businesses and consumers' spending reduces. Why is that? Because in the world of economy, in the world of business, people actually uses leverage and uses lending money and borrowing money as a way to build their wealth, to build their capital, so that they could spend money either for their personal uses or for the business uses. So if the Federal Reserve raises interest rates, maybe from a 3 to 5% to a 10 or 15%, that's a really, really big rise in interest rates, business and consumer spending reduces, right? That causes earnings of the businesses to fall, which leads to stock price drops. So as you can see from these chain of events, when we look at the business, we really want to see the cause and effect, right? So the effect of businesses and consumers spending less money could be linked back to the rising of interest rates, which causes stock prices to drop. Now, on the other hand, we can see if the Federal Reserve lowers interest rates, businesses and consumers spend more money, right? Because if you don't have to constantly be thinking about how much money you owe other people, you will be spending that time thinking about how you can spend your money and how you can actually improve your business, or your competitive advantage, your service, or things like that. So when the Federal Reserve lowers their interest rate, businesses and consumer spending increases. That causes economy to boom, because the more cash flow, the better it is for the economy. That is basic macroeconomics. Now, this process here of the Federal Reserve manipulating the rise and fall of interest rates could be called as the easy money policy. This is what this is called. The easy money policy basically refers to the increase of money supply by lowering the interest rates, right? So generally, the Federal Reserve uses the easy money policy during the recession to cause recovery and to hopefully reach expansion, and the end goal is the peak, right? So in the business world, what you really want to do is understand where in the cycle you are and what to do during that time period. So I'm a firm believer of there is a time to do everything. If you do the right thing in the wrong time, that could be catastrophic for you. But if you do the wrong thing at the right time, that could be equally as bad. So during these different sectors of a boom bust cycle, you can actually look at your surroundings, look at the economy, and see what type of investments are best, right? During a recession, where everybody is really sad and depressed and generally having a lack of faith in the economy, what you could do is look for investments such as real estate, because people are in desperate need of money, so they will go and sell their houses. Real estate, and stock prices, stocks, bonds, mutual funds, index funds. These are all really low during the recession, and you can hold on to these throughout the recovery, throughout the expansion, and then sell it at the peak. Then that is a perfect example of how the boom bust cycle could work wonders for you, right? But if you buy during the expansion and reaches the peak, and you still hold on to those stocks, when you reach the recession, you're going to lose a bunch of money, right? So it is really important for an investor, whether you're in real estate, stocks, bonds, or whatever you're in, right, to really understand which part of the cycle you are in and how you can optimize that to better suit your needs and to fulfill your general purpose, right? Okay. So this course is just a very brief intro on the boom bust cycle, the investing cycle, whatever you want to call it, as well as interest rates and how that affects the macro economy. So if you guys do find this video helpful in any way, be sure to like and subscribe down below.